Welcome back to the Energy Forum, a podcast from the Center for Energy Studies at Rice University's Baker Institute for Public Policy. I'm Ken Medlock, Senior Director of the Center for Energy Studies. A lot happened in 2025 that pushed oil prices in directions that many people did not expect. Political shifts in the United States and around the world, changes in how OPEC Plus manages production, and macroeconomic uncertainty all played a part. As we look toward 2026, the outlook is just as uncertain. There are big questions on the table. For example, how will global political shifts shape energy outlooks and energy investments? How will new sources of oil production impact markets? How do countries balance the push for economic growth, reliable energy, and lower carbon technologies? To help us sort through these issues, we're joined by Abhi, a non-resident fellow at CES and Director of Research and Advisory at Energy Intelligence, and Skip York, also a non-resident fellow at CES. Skip was recently recognized by Inc. magazine as one of the top 10 most influential leaders powering the future of energy in 2025. Abhi, Skip, take it away.
Thanks a lot, Ken. And Skip, it's great to have you here as always. Let's walk through, some of the key questions and topics and themes with regard to the oil market. So let's dive right into it. In 2025, we saw, a mix of policy issues, geopolitics, question marks around demand and macroeconomics, OPEC Plus kind of shifting course, all kind of impacting oil markets in different ways. So as we look to 2026, how do you think about it? What are you most focused on? What do you think are the key moving parts that oil market participants and then watchers should be looking to?
Yeah, so I'll start about how I think about 26 by stepping back and looking at 25. We just did our last oil roundtable for the year on December 9th, and there was really kind of a couple of key comments that came out of that. The one that I'll start with is the consensus in the room was that oil demand growth in 2025 is going to probably end up somewhere around 1 million barrels a day of growth, which was much stronger than what people were anticipating in the spring of 25, when, especially after Liberation Day and Trump announced his tariff policies. I think there was a thought that would dramatically slow global economic growth and that would slow oil demand growth. But as we went through the second half of 2025, the macro environment was pretty healthy. Oil demand was pretty resilient. And so we'll probably end up somewhere around 1 million barrels a day. We'll repeat that in 2026. But what's noteworthy as we look farther out, and in the oil industry, the long term always impacts the near term. There was also a view in the room that oil demand growth is structurally slowing. So we're going from a world pre-COVID where demand was growing at 1.5% per year. We're now down to about 1% per year, and that 1% is probably going to erode a bit more as we move to the end of the 2020s and into the 2030s. So what that sets up for me in 2026 is if I say, well, oil demand is 1 million barrels a day of growth, then the question is, how do we supply that when you really kind of have two competing factors? One is non-OPEC supply, which kind of just marches on, especially the offshore mega projects that once they start construction, it's very hard to slow or delay them. And then the OPEC Plus membership that wants to return their spare capacity back to the market. And that's going to be sort of the battle of supply. And so for me, I'm looking, what are going to be the early signs we see around non-OPEC supply growth? I think that's the key to be looking at, and especially where non-OPEC supply can be slowed down, which is largely the shale plays of the US, Canada, and Argentina, because I think a lot of the offshore projects in Guyana and Brazil, they're point forward economics, even though we're in a $60 world, and those are multi-billion dollar projects, their point forward economics are telling them to still keep going forward. So those projects will still continue to advance. So I think the question is going to be how much of that variable or discretionary or short cycle non-OPEC supply comes into the market, because that's going to influence what OPEC Plus does, or it'll be a factor in their consideration. And I think if you step back and say, is 26 going to look? Are we going to be, from a price perspective or from a producer's perspective, are producers going to be lucky enough that 26 will look like 25? Because in the early part of 2025, they were saying not going to have strong oil demand growth, non-OPEC supply growth is going to keep chugging along, no room for OPEC plus barrels to come back to the market. And they returned, what was it, Abhi, about a little over 2 million barrels a day of capacity was released back into the market. Now, not all of that turned into production, but OPEC plus did bring barrels back into the market. And I think as you're sitting in December of 2025, I think a lot of people are surprised that oil prices are in the 60s. I think they would have said if you'd played out this scenario for people in January of 2025, I think you'd see the consensus would probably be that prices are in the low 50s, if not the 40s. And although $60 isn't a great price, I think prices are much firmer than what people would have expected them to be had they known that OPEC Plus was going to bring a couple of million barrels a day of capacity back into the market. So I think now as we play into 2026 and we're already in an oversupply, if OPEC Plus continues returning barrels, does price remain that resilient in the low 60s, or do we see downward pressure on prices, which will then impact some of those shale drilling decisions in the later part of 2026?
That's right. No, I think thanks for teeing up all the kind of the key moving parts very clearly, Skip, and then we'll dive into a couple of these things. What do you make of this perceived oversupply that the market is tipping into? I mean, you mentioned we're already in an oversupplied market to some degree, right? I mean, prices have come down. We're barely holding 60 for Brent, and we've been in the 50s for WTI for some time now. But there's an expectation that things get even worse as we kind of end up the year and head into 1Q in particular, right, where supply is likely to hold, even if it pauses, but the demand takes kind of a seasonal dip. So, what do you kind of make of this perceived oversupply? Is it, kind of overstated? As you mentioned, given the market has held up, maybe better than what the numbers, at least on paper or on spreadsheets, would suggest. Or do we really need to make a trip into the 50s or deep into the low 50s or even lower for the market to really clear out? What do you think about that?
Yeah, so I think the curious part, what we have to figure out as oil market analysts, is how do you handle Chinese stock building? Because historically, stock building has been done in the OECD countries largely by the operators, by their private barrels going in, and the market kind of knew that a barrel that goes into storage today is a barrel that gets returned back to the market at some point in the future, and not really in the not too distant future. We're not really, I think the market is trying to figure out, how does the forward curve get impacted by Chinese building strategic stocks? Because I think that the view is that the Chinese are not going to be, they're not going to play this temporal arbitrage where they're buying oil low in an oversupplied market today, and then they're going to sell it back into the market when prices recover in the future. It might be a buy and hold for strategic purposes, and so it's not the market that's going to drive when the Chinese consume those storage barrels. It's going to be their supply security and their supply availability that will drive it. So if we're in that latter world, the Chinese barrels going into storage are barrels that are disappearing from the market because we just don't know when to attach their return back to the market. That might be part of why prices have stayed so resilient, is that I think there's an expectation in the forward curve that the Chinese storage build is not going to get consumed in the near term, which means that the Chinese will be buying barrels today to run in refineries and to store. And in the future, the Chinese will still be buying barrels in the market to run through their refineries. They won't be drawing down their stocks. I think that might be the mental model. And if that mental model is correct, then you're right. The oversupply on paper, the market is actually physically tighter than what the oversupply on paper is suggesting, because a lot of that oversupply is going into a strategic storage bin in strategic inventories with little to no expectation of them returning at any point in the future. I actually did have a conversation with somebody at the Baker Institute on Tuesday after the roundtable where he said some of the things he's hearing, and it's his concern, is that there's a bit of a view that the Chinese might be building oil storage in anticipation of eventually invading Taiwan. And so there could be this view in China that we're buying barrels today while the world will let us buy barrels, and we're going to hold them because when and if we decide to cross the straits, the world market's going to shut us off, because they're taking a lesson. The lesson learned for them in the Russia-Ukraine conflict is that the world will impose, in the case of Russia, supply side sanctions. I think that the view of the world says in the Chinese mental model is that the world would sanction the Chinese buying oil in an effort to try to deter conflict. And so if that's why they're building storage, those barrels are going to stay there independent of what market prices are doing. So it's an uncertainty that I think so far is the market in a world is the best thing. Well, every barrel that goes to China is a barrel that just disappears from the market. And that strategically might be the right way to think about it.
Yeah, no, I think that's right. And those are, important points in China, and we'll kind of see what some of the reasons and rationale behind it is. But, certainly, the price environment has been friendly to them, right? And sub 70, and in some cases sub 60, and depending on where they're sourcing crude from, into the 50s, it's an opportunistic time for them to stock up. And even on, in my estimation, China's adding a couple hundred million barrels of storage capacity that's been ongoing and will continue into 2026. So to your point, yeah, I mean, that appetite should continue to be there. And I estimate, on average, 400,000 to 500,000 barrels a day of storage can continue to be filled looking to 2026. Which certainly helps to soak up some of that excess supply, whatever the magnitude may be, and then provide a little bit of that buffer, that downside support to prices. So that's certainly something worth watching. Let's talk a little bit about geopolitics and risk premium and sanctions and that whole complex. So I think it's fair to say barely trading 60 here for Brent, that the prices aren't really showing much of a risk premium. What is your take on some of the the moving parts, Middle East, attempted end to the Ukraine conflict, and some of the other sanctions regimes that are out there, whether it's Russia, but also areas like Venezuela, for example. What do you think are all the moving parts, and what do you think looking to 2026 our constituents should be following?
Yeah, I think so. I'll say on this that I'm a bit of two minds on the price premium. I think you're right. There doesn't appear to be much of a risk premium in the oil price right now, and I think it's really being driven by two things. One is, you go back to the 2022 and the Russia invasion of Ukraine. I think the market never had an appreciation. The market now has an appreciation for how quickly oil, because it's fungible and because it's easier to transport than gas, how easy it is for oil supply chains to rearrange themselves. And so the global oil supply chain, I think, is actually much more resilient than people actually anticipate, because I think they never had to think about it. And Russia, Ukraine forced them to think about it. And what we saw was this unbelievably quick rearrangement of trade flows of oil, and the world stayed supplied. The other part of it, of the low risk premiums, is I think there's also a complacency. So part of it is we don't need it. There's not as much of a risk premium as we feared, because the system's actually more resilient than we thought. There's also a part where I think we might be overestimating the resiliency, or we might be becoming a bit complacent. And specifically around the Middle East, I have a concern that, and we always talk about the market, but there isn't the market, right? There's just lots of participants in the market. But I think that I'm concerned that there's a view that the geopolitics of the Middle East have sorted themselves out after the short conflict between Israel and Iran, and that didn't disrupt oil markets very much. It was, literally, you could measure the disruption in days. I think and nothing's happened in sort of the next 5 months. I think there's a bit of complacency that the geopolitics or the geopolitical risk of the Middle East has evaporated. And I don't think that that's true. I think there's still a latent risk out there. And you used up a chunk of your resiliency in 2022 with rearranging Russia-Ukraine. I don't think you can assume once you've reorganized trade flows, the next trade flow is going to be harder to reorganize or restructure than the previous one. So I think that's where my concern is, that the risk premium might be a little bit too narrow in the price, because if there is a geopolitical need to rearrange trade flows of oil globally, it's going to be harder to do it in the next round of rearrangement than it was in 2022, despite the fact that we were much better at doing it in 2022 than we thought we would be. It's going to get progressively harder, because the degrees of freedom of where you can take crude from and put crude to, those degrees of freedom shrink every time you have to rearrange the portfolio.
No, that's right. I think certainly there are still, kind of latent risks that are out there, and and certainly there's a lot of focus on Ukraine, for example, and I think Venezuela has gotten more focus, but I hardly, hear anything about, about Iran anymore, right? And certainly, the risks around the nuclear program, and I'm paying attention to that, haven't gone away, and it's certainly something to watch next year. And, and then kind of related to, conflict and sanctions, I think the other thing to kind of keep in mind is, this combination of sanctions and enforcement and whatnot, and maybe some other dynamics around shipping. We've ended up with, a big increase in oil that has basically, been effectively stored on water, right? It's kind of floating around, hasn't found a buyer yet. Typically, over the last, several years at this time of the year, you have a little bit over 1 billion barrels a day that's on water, including oil that's in transit. That billion to billion, 1.1 billion barrel number now is 1.4 billion, and maybe a little bit higher by, according to some industry sources. So it's well over, 20-25% higher than normal. That also poses a risk. That's something that the oil market has to watch, because if that gets flushed out, then that poses downside risk to prices. But if some of the sanctions and other things remain, and some of that, some of that volume gets frozen out, and these are barrels from Russia, from Iran, from other places that, that have contributed to kind of the bulge, then that, can kind of continue to be a headache for the oil market. So certainly something to watch. I wanted to just
Yeah, let me just come back and jump in on that really quick, and let's just remind our listeners that the stock of oil tankers in the world is fixed. So you've got tankers that are moving oil, and you got tankers that are storing oil. Those tankers can't store additional oil. So as the oversupply rolls into 2026, there are fewer and fewer tankers that can be filled for storage on water, right? Because you need a certain number of tankers to transit, and then you're already using some tankers for storage. And your point is, we're using 25% more tanker capacity now than we normally use for storage. There's a limit to that. And when we hit that limit, we might see a volatile reaction to prices if the industry figures out that there are no more tankers available to store oil on the water.
No, that's absolutely right. One of the things I wanted to come back to is, your comment on non-OPEC plus supply being a key thing to watch, and company strategy, and and spending plans, and thinking about, not just, a year or two ahead, but the medium to longer term, right? The 5+ year view. So how do you see, kind of companies planning, adjusting, adapting, to a whole host of things, from consolidation to lowering costs to efficiencies, and really kind of preparing for, for what the demand cadence looks like, right? And and I think there have been a lot of revisions on numbers, now, calling for the oil demand to be, kind of, hold for longer. And to your point, yeah, I mean, I think there is a structural slowdown in the growth, but it is still growing. We'll sort of see what, peak plateau looks like and when. But, it's going to be, it's becoming kind of more and more of a view that, oil demand is actually going to hold firmer for longer, right? Through, let's just say, at least like the 2040 timeframe, that we're going to be talking about 100+ million barrel a day market, and not something that's falling below. So maybe just a question on, how do you think companies are adjusting for this? Maybe both a near term, but also a medium term question. And and in a, price backdrop that, we've kind of left the 70s, 80s behind, and companies need to plan more for, 50s, 60s. Have companies done enough? Have they made enough capex adjustments, or, or have we, seen a little bit of like, a wait and see approach over the last several months, and, expect, certainly if prices dip into the 50s, more change to come. How do you think about all these moving parts?
Yeah, I think what you're going to see is both in the near term and the longer term. I think capital discipline, and I hate to be extreme, but I won't say capital discipline is here to stay, but I think the industry is much more disciplined about deploying capital now than it has been at any point in our history of the industry. And if you just kind of look at, two of the capital guidance reports that came out recently was ExxonMobil and Chevron. Both of them fairly tight on capital, not a big increase. I think Chevron actually was a little bit smaller. Their 26 guidance is a little bit lower than 25, but not material. But if you kind of looked at it, their how their strategy for deploying capital is largely unchanged, where most of the capital is going to be spent on those long dated offshore projects like Guyana and Brazil. And those are those are projects that take time. There's a lot of capital up front, but they also produce, for years. Well, they have very long flat plateaus on their production profile. And then there's still substantial, both of those companies are still going to spend substantial capital in their shale positions, which is largely kind of consolidating into the Permian. And I think that's what we're going to see as capital guidance comes out for a lot of the other companies in the month of December and into early January. Is I don't see a big change in capital allocation between 25 and 26. And I think to your point is that might be setting up a bit of a supply crunch or some supply tightness as we get to the end of the 2020s and into the 2030s, because we might be developing if you think about your offshore projects, you might be developing all of your $50 and $60 onshore projects today, offshore projects today. But your next wave of offshore projects that are in your hopper, maybe their break evens are in the mid 70s, or somewhere in the 70s. And what you've got to do is figure out between now and sanction, how do I get that project to be competitive in a lower price world, in a world that's maybe in the 60s? And that's difficult, but it's not impossible, because we've actually seen that a number of projects, especially like in the Gulf of America, when oil prices collapsed in 2014, there were a number of projects that were delayed in the Gulf of America, but eventually did get done. And that pause was, how do we make this world? Okay, it's no longer $100 world. It's now a $75 or $80 world. How do we make that project now fit from in a $100 world, in a $75 world? And it paused projects, but it didn't cancel them. And I think that's where we're at right now. And that's what we don't have a lot of visibility into how companies are thinking about taking that $80 project and making it a $70 project, or taking a $75 project and making it a $65 project. But I think that's the work that's going on now. The question is, if you're right, if demand growth is going to be more sustainable than we thought it was going to be, there's a race against time. Is that demand growth is going to chew up existing production while you're racing to get that $75 project to $65. And can you get that project cost effective, developed, and online before you run into an imbalance on the other side of this, which is the other the other concern that I have is, the weaker prices are, I think, in 26, 25, 26, potentially into 27, the greater it sets up the chance for the rebound in prices to be, much more like a rubber band. We're pulling that rubber band farther and farther back. The longer prices sort of stay low and demand just continues to march on. Big changes in supply don't happen in weeks. They happen in years. And that's what I'm worried about is we could be setting up the low price environment of today could be setting up a much more serious rebound in prices near the end of this decade or early 2030s.
Yeah, no, I think that's right. And to your point, I mean, just to add, I think, efficiencies and, adjusting, technology levers, especially, in the US shale patch has been a thing, allowing operators to do more with, kind of fewer capital dollars, right? And kind of lower break evens. But, I think, I think there's only, kind of, so much that can be done. And to your point, yeah, I mean, it really does look like, 2026 will at least start off soft from a price standpoint. And again, depending on potential surplus and if OPEC plus, kind of continues to grind ahead, it could be a soft year, especially, kind of in a midterm year, right? President Trump will be looking to kind of keep, prices, depressed. Whether he succeeds or not, we'll see. But could it could be a soft year, the whole of next year, and companies, may have to kind of, adapt a little bit more, to that environment, which sets up, kind of different dynamics looking medium to long term for sure. Maybe we can just touch on one last question, which is, maybe a refining question, because I think, this also is a kind of a near-term question, but also, a medium to longer term one. Because I think, this low price environment, very strong refining margins, and plus, kind of, storage buffers and things like that, are providing a floor under prices, right? Or seem to be, at least for now. It's a pretty nice time to be a refiner. But looking to the next couple of years and then maybe over the medium term, how do you think about kind of the refining complex? Is it a little bit of a wait and see right now to see, especially what happens to transportation fuel demand? Maybe approaching 2030, do refining operators just going to continue to just enjoy the environment and not allocate capital to any sort of expansions, any regional things that you'd point out? Because I know this is your area of expertise. What are you seeing here downstream?
Yeah, I think, I'll try to say a couple of quick thoughts on it. One is I'm increasingly concerned from a global perspective. We talk about that the crude oil market is oversupplied. The refining market is heading in the opposite direction, where the refining market, refining capacity is tight and getting tighter. We're building them about half capacity wise. We're adding about half as much capacity over the last 5 or 6 years if we have over the last 10 years. So instead of adding, about 1 million barrels a day, 1.1 to 1.2 million barrels per day of new refining capacity every year, we're now closer to about 600,000 barrels a day of new capacity every year. The scary thing about that is that there really isn't any large material capacity projects out there beyond 2027. So the build out is exhausting itself. So we're adding less capacity. And at the same time, we're closing down capacity at about double the rate that we used to. We used to, historically, we shut in about 500,000 barrels a day of refining capacity every year. Now that's up to about 800,000 barrels a day and potentially going higher. And there's a reason for that, because we're closing refineries where demand has peaked and is declining, like Europe and Japan. And we're still adding capacity where demand is still growing, which is really kind of Asia over to the Middle East. And the Middle East is adding capacity not only for its own needs, but also because it's a short hop into the growing Asia market. So part of this is that the refining capacity is rearranging itself globally, but it's also rearranging itself sort of on a net capacity basis. We're not seeing a lot of growth in net refining capacity, which says the demand growth that we've seen, like this is a great year example, is that we're seeing refining globally, we're seeing refining utilization rates above 80%, approaching like 83, 84%, which may sound like we've got a lot of spare capacity sitting out there. But historically, the global refining average has been below 80%. So we are stressing the global system about as hard as the global kit. We're running it about as hard as we can run it. And demand keeps growing, but we're not adding refining capacities. So, we could be in this world where from a consumer standpoint, becomes a bit of it becomes a bit of a dissonance for them. Is they're like, why are oil prices falling? But when I look at the service station, every time I drive past the service station, the price of gasoline is going up. Now, normally those two prices move in the same direction, but we're starting to see, especially in diesel, where despite the fact that we've got crude prices falling, we've got diesel prices rising in most of the world. And part of that is that we've got a capacity constraint at the refining link in the value chain. And that link it's like a large project. Adding capacity takes about 5 years from when you start construction, and we don't see a lot of new construction starting. So if you're a consumer sitting in a high price environment, I don't think you're going to see a lot of relief from softening crude oil prices, because you're increasingly competing against somebody else for that barrel of diesel or that barrel of gasoline, as opposed to your input costs or the price of your input costs are going up or down. It's definitely something to watch. We should take a closer look as we're going into 26, and really maybe a year from now we come back and revisit this again, because I think 27 and 28 is where it becomes a real issue for consumers.
Yeah, and definitely, and even in 2026, something to kind of watch some of those moving parts.
Yeah, start watching it now, because I think there's an issue coming, and we don't have a time, and it takes too long to build your way out of it. So I think we're going to see some of those signposts in 2026.
Right. Thanks, Skip. Perfect. I think that's about all the time we have. Skip, thank you so much for your insights and your outlook on oil downstream and other markets. Certainly, there'll be a lot unfolding and a lot that we'll be paying attention to that we'll keep coming back to and incorporating into our research and also our our future podcasts and events at the center. Just wanted to wish everyone a happy holiday, and we look forward to continuing to work with you in 2026.
Yeah, thanks, Abhi, and looking forward to working with you more in 26 as well.
Thank you for tuning in. Subscribe and follow the Energy Forum and the Center for Energy Studies for more expert insights on global energy trends. This episode was produced by Maram Hijazi. Stay productive and never stop learning. Until next time, I'm Ken Medlock.